Hello everyone, welcome to 2021 tax season. This is Wubishet Mahari from Gion Financial. For this video, I selected few important topics to help you prepare for the coming tax season. So I hope you will find this video helpful. So why do we have to file tax return? So throughout the year, whether we are on W-2 or self-employed or business owners, we pay our taxes throughout the year. So they call it pay as you go. So at the end of the year, once the calendar year is over, we have to gather our documents and reconcile our tax with the Internal Revenue Service, which means if we were on W-2, we have to see if we paid enough tax, if we underpaid, or if we paid exactly what we were supposed to pay. So if we end up paying more than what we were supposed to pay, we get a refund. If when we reconcile, if it is below what we're supposed to pay, then we'll have a balance due. In rare cases, for some of us, we may find out that we have paid exactly what we were supposed to pay. Therefore, no refund, no balance due. So for self-employed people, throughout the year, unless you're paying estimated tax, this is the time where you calculate your tax and pay your income tax, social security tax, and Medicare tax. So almost everyone who had earned income or investment income that's above your standard deduction have to file tax returns. And it's not only because you owe IRS that you have to pay or because you have a requirement to file. So it's also a lot of times to your advantage to file and claim a refund. So it's always good to make sure, even if you don't work and you have a small amount of income, it's always a good idea to calculate your return and see you don't miss out on a refund. So when do we file our tax returns? Tax returns are due from end of January until April 15. However, if we miss that deadline, it doesn't mean we cannot file any longer. In fact, if we miss the deadline April 15, we have to file as soon as possible. Especially if you have a balance due, IRS will start calculating penalties and interests as of April 16. If you have a refund, however, you have 3 years to file your return and get a refund. If the 3-year deadline passes, you can file, but IRS will not issue a refund for you. So make sure not to forget to file before the deadline. That's for personal is April 15, and for business, if you have any type of business other than self-employment, you have to file by March 15. That's the deadline for business filers. So the next question is, who has to file a tax return? This is simple answer. Anybody who has cash income of over 600 has to file. If you are not on a W-2, doesn't matter what type of job you have, whether it could be babysitting, it could be Uber, Lyft. If you have received more than $600, you have to file a tax return. And that income, as long as you are a green card holder or a citizen, it doesn't matter where the income was earned. It doesn't have to be in the U.S. U.S. taxes its green card holders and citizens based on worldwide income. So if you make over $600 on 1099 or cash, you have to file. If you make over $12,400 and you are on W-2, you have to file. Again, filing is not an option; it's an obligation. But even if you make less than that amount, it's always good to check to see. Even though you don't have your income is below the amounts, it's always a good idea to check and see if you can receive a refund. So once we find out how we're going to file, our filing status, the type of income we have, the next question is, of course, and our main goal as tax preparers is how to minimize your tax liability or how to maximize your refund. So the next topic is very important. It's one of the main reasons you file tax or why you need tax professionals like us, so that we can help you pay as little as possible legally or maximize your refund. So in order to do that, we have to look at what deductions you qualify for, what credits you qualify for. So some of the deductions and credits are, I will start with deductions. The most common ones are if you are paying student loan, if you gave donation this year, if you have mortgage interest, education payments, medical expense are some of the common ones. Also, with credits, those are the best ones. Basically, deduction, you use it to lower your income. But credits are much better because credits, you get $1,000 credits. That means you can lower your tax by $1,000. Deductions, on the other hand, your income is $10,000 and you have 1,000 deductions, and it just lowers your taxable income. So the benefit of credit is great. And some of the common ones that you are probably familiar with are child tax credit, earned income credit, education credit, are some of the best ones. And this year also, if you did not receive your stimulus check, you're going to receive it as a credit. So in order to get these credits, of course, you have to make sure you have all your documents. If you have dependents, make sure you have their full information, social security number, date of birth, and sometimes IRS may ask you to prove that you have a relationship with the dependents, they live with you, and that you provided support. The next topic I want to discuss is what's new in 2021 tax season. The first one you should be aware of is that IRS has stated they will start processing tax returns as of February 12. However, it doesn't mean you can't get your taxes done before then. Our offices are in fact open and we're processing 2021 tax returns once you gather all your documents. And that's the most important thing. Especially this year, another new thing is most people received unemployment compensation, which is fully taxable. So until the state sends you a 1099-G with your unemployment compensation information, you cannot file your taxes. That's something you should be aware of. Make sure you collect that information. The other topic you should be familiar with is your stimulus check. If you received your stimulus check, both stimulus checks, you don't have to do anything. But if you missed or you received lower than what you're supposed to pay, now is the time to claim those credits. When you file your tax return, we will ask you if you have received both stimulus checks, and if you haven't, it will come to you as a tax refund. The other change this year is how your donations are treated. Before, if you gave donations only, you could have used it only if you itemized your expenses. But this year they have made some changes. So up to $300 cash donation is deductible from your income. Another major change this year is, last year, as most of you know, one regulation that IRS came up with is you could tap into your 401k or as a retirement plans. For any reason, if you took money out from your retirement or pension plans, up to $100,000 of it is penalty free, but you are still paying tax on it. The only thing that's left is before, if you took money out before you are 59 and a half, you're paying penalty and tax on it. But this year you're only paying tax, so that's a good news for those of you who tapped into your 401ks. So another new development in 2020 was the Paycheck Protection program. So this is particularly applies to self-employed individuals. So if you took money from the PP program, it's also another good news. Most of it's going to be forgivable as long as you used the money to pay for specific expenses. Not only that, what you should be aware of is if you took that money and used it to pay rent, utility, or interest expense or payroll, yes, it's forgivable. But if it is forgivable, that means you cannot use it as a deduction. So if you took $10,000 and you paid that for rent, then you cannot turn around and claim a rent deduction. So you should also be aware of that. So, like I said earlier, when you file your tax returns, one of the three things could happen. You could get a refund, you could owe, or you could even out. So if you have a refund, then you have multiple options on how you can receive your refund. You can do direct deposit, or you can choose a check payment, or you can even use your refund toward next year's tax payments. So you have different options. The second one, well, a challenge for a lot of people is when you end up owing. So all of a sudden you're expecting a refund, now you owe. So how do you pay it? There's also a good news there. If you have a balance due, IRS is flexible on how you can pay. They allow you to make installments. You don't have to pay all at once. You could do up to 72 payments, which is almost 6 years. But of course, like any other balance dues, there will be interest payments, which is much less than a credit card or in other loans, but they allow you to take time in paying off your balance dues. So if you end up owing, that's a signal for you for the next year. You should talk to us or talk to your tax preparer what you should do next year. There are multiple things you can do. One is contacting your employer and asking them to adjust how much tax they take from your paychecks. The other one is if they are not taking enough, and especially if you are self-employed, the best way to avoid having a big tax bill at once is to do estimated tax. IRS encourages anyone who owes over $1,000 to pay quarterly based on estimates. So that's filed April 15, June 15, October 15, and January 15. So by the time you file your tax returns, you may even have a refund. So estimated tax is something you should always consider when you have a balance due. Because if you have a balance due of over $1,000, there is an automatic penalty from the IRS, even if you file before April 15. So make sure, if you think you're going to owe, make sure you pay it before January 15, the last quarter payments on January 15. So as long as you pay your balance before January 15, then you can avoid paying penalties. So another topic that I want to discuss is audit, something none of us want to hear from IRS. But so how do we avoid audits, and what does an audit entail? So first thing, most people assume the moment we see a letter from IRS's audit, but that's not true. IRS could contact us for so many different reasons. For example, we miscalculated a number, or we had a typo, and say instead of entering 20,000, we enter 2,000. In those cases, IRS is simply notifying us that we made an error in data entry. So they're just asking us to make a correction. But when it's an audit, they will specifically tell us that we are being audited. They will usually they just ask us to provide documentations if it is not serious. If it is serious, they will assign someone from our local areas, and that person will communicate with us, and they will tell us exactly what they are looking for. IRS audit is not as bad or as scary as most people try to make it. The only time you should be concerned is if you have intentionally understated your income. That's the most serious one. Otherwise, they will work with you, they will tell you exactly what they need, and at that point you should contact your tax preparer and work with your tax preparer and provide informations. So the best way to avoid audit or letter from IRS is make sure you report all your income and make sure you keep your documents at least for 3 years. IRS usually doesn't audit, that doesn't go back more than 3 years unless they detect an intentional tax evasion. If that's the case, they can go as far back as they like to, but usually you can expect to be safe after the 3 years has lapsed. The last topic I want to discuss is state income tax. Just like federals, except 7 states, every state has their own tax code and you have to file with your state. Here, the only thing I want to say is, especially people living in tri-state areas, the most important thing to remember is that you pay tax in a state where you live in. For example, in our area, in DC area, if somebody lives in Virginia and works in Washington, DC, only Virginia you will pay tax only in Virginia. If DC or Maryland took money from your paycheck, they will give you all of it back. Another thing to be aware is, let's say you moved from Virginia to Maryland in the middle of the year. So you file in both states for however many months you lived. If you live in Virginia 6 months, 6 months in Maryland, you file both tax in both states, and both states will treat you as a party resident. So that's all for today. Thank you for watching this video. Please subscribe and like our videos and share with family and friends. From time to time, we release different videos on different topics on tax, personal finance, and other topics, and it would be great to have you as our audience. Thank you very much.